John writes, I have two questions. I am looking to start a dividend portfolio. I am 31, so I have plenty of time to build this up. My father, however, will be 60 soon, and he would like to transition to more dividend stocks for income in retirement. I'd like to help him build this portfolio and maybe mirror it with my own. How should we go about constructing one? Is it simple as just buying 5 to 10 good-paying companies in a brokerage account? Do you start out with many small positions or 1 to 2 large positions and add to them? We're probably gonna have to refer back to this, but Dylan, thoughts?
Yeah, so a lot to answer there. Great
It's
question.
actually like 5, 6
and yeah,
questions.
there's I mean, it's
You
great 'cause,
cheated,
like,
John.
identifying dividends, portfolio construction, a lot to digest there. Constructing a portfolio, I think we should just start there. It's no small feat, and I think when I was thinking about how to answer this question best for our listener, I revisited.
Disclaimer: neither of us are
not
certified financial planners.
No,
We're
but-
two guys in a podcast.
But I revisited our 13 Steps to Investing Foolishly, which is on Fool.com. Excellent resource for
Good
people
plug.
that are looking to get started, or just kind of want a refresher on some things to keep in mind. Sometimes you kind of wind up down the road somewhere, realize that you are super overweight in one sector, or maybe you haven't been dollar cost averaging well, things like that. It's always nice to just kind of get a refresher on the basics. So I revisited that, and I found this great quote. You want to invest in sips, not gulps. And I think that is, and Sean is going for the coffee.
I took a sip,
Yes.
Dylan.
And you feel like you're comfortable taking it.
I am, yeah.
You're,
Now
not,
I'm
you're
gonna
not
go-
scared that you took too much of a gulp.
I'm gonna go invest in my 401k
Yes.
in a sip.
And so this is a great way to think about adding to positions, creating positions, and starting out your portfolio. And I think there's a couple reasons for this as just kind of a guiding light. And one of the main ones is it's incredibly tough to time the market. And so if you are investing in gulps, so if you are buying very large positions in
Everything today.
in 1 or 2 companies, you are going to be hit by volatility at some point, or you are going to buy on a very up day. And so I think one of the maybe it was a Morgan Housel tweet or something like that I saw a little while back was like, figure out what you want to buy, commit to a schedule to buying it unless the investing thesis changes, basically. And it's like, you'll add to the position over a period of 4 months, 5 months, and you will regularly buy into it. And so that's one way to kind of mitigate against some of that timing the market risk, because none of us can do it, right? I mean, like, you might look at like, it looks oversold today, it's a good time to buy, something like that. But if you're long-term oriented, like, that kind of stuff shouldn't matter. And it's better to work towards a better dollar cost average, over the course of kind of a medium-term amount of time, I think. Another reason that I think this is a great way to think about investing is you're going to be wrong a lot. So if you are investing in SIPs rather than gulps, I think you start to learn quite a bit more about a company after you invest in them, unfortunately. Like, this is something that I've found, at least. I don't know about you.
Well, yeah, and even Warren Buffett, when he, I read this awesome thing one time, and it wasn't in an annual report, but he said that whenever he is interested in a company, like, a couple of years ago, he's been buying into, I'm going to plug a tech name, IBM. Yeah. When he was, curious about IBM 4 or 5 years ago, I'm sure, he did this. He buys a couple hundred shares of the company. They'll send him the annual report. And by buying just a small, tiny little stake, it actually triggers something in your mind to where, I actually have money in this. I should probably look into it more.
Right.
So, again, even Buffett sips.
Yeah, and that's actually another point that they draw in 13 Steps to Investing Foolishly is buy one share to start. If you've never bought any stock before, buy one share in a company, and you'll realize that you are now paying attention. Obviously, if you're looking to build out a portfolio, maybe you start to do that at a little bit of a larger scale. But I think just kind of a case in point as to why you're going to be wrong a lot. In my personal portfolio, if you were to look at just like binary up or down, I'm down in like 40% of my positions. Granted, like, I'm very like tech centric, but like, my winners have proven out, and overall I'm up. But if I were to have only invested in 2 companies,
right,
I might be looking at like negative portfolio returns. So kind of to your question about, is it better to buy 5 to 10 good companies or build large positions of 1 to 2? I would go with the 5 to 10 and slowly build out larger positions in each of them rather than be highly concentrated in 2 companies.
Well, not only that, but John, both you and your dad have nothing but time. He is only 60. In America, the life expectancy is above 80. You're 31. You have you have plenty of time to do this.
Yeah. I will say there are 2 things that are going to tempt you away from this line of thinking, and I think it's good to just kind of air them out now so that you're aware of them, and maybe you won't be as as biased by them when it's time to actually make moves in your portfolio. One of them is transaction fees. And I know it's just something that kind of creeps into my mind is like, well, all right, if I'm ultimately looking to invest like $2,000 in a company or something like that.
And I buy 10 positions and it's $10 commission each time. That's $100.
Yeah, it adds up. So, you're like, oh, well, I can just buy once and, have a much lower transaction cost as a percentage of what I own. Again, like long term, so is that 1% or whatever really going to matter all that much over the course of years of compounding, whether it's dividend income or stock price appreciation?
No.
Yeah,
especially if you're buying like one position per month or whatever you're doing. Like transaction costs are important, and the best investors in the world talk about them a lot. But it's actually they're framing it in reference to not day trade, not long-term slow position building.
Yeah. So don't worry too much about that. I think as long as it is not eating up a humongous chunk of your actual transactions, then it's not really something to be too much worried about. And also, I think it's always tempting to want to see immediate returns and hit scale, and the easiest way to do that is to buy a lot at once. But again, knowing that you will be wrong some of the time, and the market will take weird downturns because of macroeconomic factors,
right?
Or something like the retail industry getting hit really bad, which we saw last week. Were you to be buying ahead of something like that, you'd be in a rough position, right? So I think that those are just some good things to keep in mind with respect to that question.